The question today is, when investing for safety and income, do you invest in bonds or invest in an indexed annuity? Or do you invest in both? Today, I'm going to talk about why adding an annuity to your portfolio is the right choice for people who don't have money to burn. I wouldn't say all of your money should be in an annuity, but if you're 50 and older, likely some should be an annuity. The rules of the game have changed. When you enter retirement, you should be thinking about distributions as well as longevity risk, which is running out of money before running out of life. This should be a major focus. Investing in the stock market is the best place to be when the market is good. You can make outsized returns and really grow your savings, but it's not always the best place to be. The risk in the stock market is mostly why people, especially when they get older, add bonds to their investment allocation. Again, the idea is that bonds have always provided more stability and less volatility, as well as an income stream. But that's changed a lot in the last 10 to 15 years. And from a historical perspective, today bonds pay very little interest. The safest bonds are paying around 2%, and the riskier bonds, high yield bonds and so forth, are paying closer to 5%. There's another issue here. If interest rates start to rise, your bond investments are most likely to go down. Alternatively, high-yielding bonds have even more risk. If the economy starts to falter, high-yield bonds are the first to fall. At the onset of coronavirus last year in 2020, many of the higher-yielding bond funds fell 20% almost immediately. They've since come back, but that's a lot of risk for a 45% return. With bonds paying very little interest and also carrying a lot of risk, why not look at an index annuity for a safe return where you are guaranteed not to lose a dime? Annuities are created by insurance companies who are best at managing bond risk. That's what they do. Insurance company portfolios are mostly comprised of bonds because bonds are predictable and guaranteed. If you have billions to invest and have a team of highly qualified people with decades of experience, they're bound to do a good job. This is what insurance companies do. And many insurance companies are 100 plus years old and they're managing billions and billions in bonds. Some of their portfolios are invested in bonds purchased 30 years ago, which means their yields on those bonds are much higher than most bond funds, ETFs, or single issue bonds today. Unless, of course, you bought these single issue bonds 30 years ago, of course, when rates were much higher. Here's how index annuities work. You can't lose anything. The worst you can earn is nothing. For an investor who is focused on having a dividend paying them monthly or quarterly or yearly, generally will pull from the cash value of the annuity in any year it doesn't earn a credit. Or when it even earns a credit, they'll pull what it earned. The best return you can earn in an index annuity depends on the index you choose, but we've recently seen returns of 10 to 14% in the last year or two. Now, the 10-year average on index annuities is around 5%, 3% on the low side, 8% on the high side. So you can't lose a dime. The average return has been about 5%. That's the high end of what risky bonds pay today. And knowing that, does it make sense to only own bonds and not consider an equity index annuity, especially when rates are in the tank today? The bottom line is that fixed income investing has become infinitely more complex with interest rates fluctuating at these low levels like they are today. If you have any questions or comments or are interested in exploring annuities or discussing anything else financially related, don't hesitate to reach out to me. Thanks for listening.